In this week's update, it's all about the CPI and the Fed next week. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. Short and sharp this week, nothing has changed, and frankly, until we see the economic data, the inflation data, and the Fed rate decision, and probably even more importantly, their commentary about the next few quarters, I think the market's just going to be hostage to that. So nothing new this week. The S&P had a negative week. I think there was a rethink. The prior week we saw a lot of enthusiasm that the Fed was likely to to perhaps do a big pivot, and then some stronger data came through, and that sort of threw a bucket of water on that, and so the S&P went back down again. One little bit of green shoots, I guess, nothing startling, but semiconductors did okay last week. They're probably one of the better industry groups, so that provides a little bit of encouragement. But that sort of will pale into insignificance compared to what the Fed has to say this week. Energy was the worst performer, and I haven't said that very many times in 2022. It was clearly the drag. The sector's going through a correction, which of course is normal and happens all the time. It was just a matter of when that was going to occur. The US dollar index, pretty steady, just a tick under 105. The 10-year yield kicked up a little bit, obviously with expectations that maybe the Fed isn't going to pivot yet. The VIX, that also bounced up from around 19.5 up to nearly 23. And the 10-year, 2-year yield spread was steady at 0.76. So these are all pretty much the moves that you would expect. All right, let's start. First of all, let's start with the individual sectors. So big picture, this is XLE, the energy sector for America. 200-day moving average still looking really good. We've seen in June, we saw a pullback to just a touch under the 200-day. We saw that again in September, and they proved to be very good buying opportunities. And I suspect we might see something quite similar this time around. So we've formed a big double top here. So an appropriate time to get more of an ABC kind of correction. I think we're still in the A leg. So I'm expecting that we'll get some sort of bounce, and then we'll get another retest to the downside. So, very similar to what we saw here. There's the B leg, there's the C. Here's our next A leg. On this particular correction here, here's our A leg, there's our little bounce, and there's the completion of that correction, and I think we'll see something quite similar this time around. So I can see that that energy potentially is building up to an opportunity. We're not there yet, and we need to see confirmation of the reversal, like we saw here and we saw here. But I think that's an opportunity that's building. This is XLF, so again, just observe the 200-day moving average. The price of the index has managed to climb back above it, but still not sufficiently yet to turn either the 50-day or the 200-day, or put the 50-day back on top of the 200-day. So that's still a work in progress for finance, although within the finance sector there are some industry groups that are doing pretty well. This is XLK, so technology. We're still forming lower highs and lower lows at this point in time. 200 days still pointing down, and none of the moving averages are in positive mode yet. So technology has not yet been able to break out of the downtrend that it's been in throughout the year. And finally, this is another sector that is starting to to build up some positive momentum. This is healthcare. We're now quite clearly back above the 200-day, which is just starting to turn up. So you can see when you look at this compared to the prior two sectors, healthcare is certainly the one that's moving right at the minute. Energy in correction mode, but still in big picture uptrend. So that's where the momentum and the cash flows are going at the moment in America. There's the S&P. We had a little peak over the 200-day, which is still pointing down, and then fell back again to where we were 2 or 3 weeks ago. So not a lot of change there. The important spread charts just to determine where the money is actually going. This is US small cap growth versus value, just tracking sideways, no real difference there. This is consumer discretionary versus staples. Tesla's been under pressure. Amazon is just forming a bit of a base by the look of it, so they're always going to keep the lid on consumer discretionary at this stage. This is semiconductors versus the S&P. Semiconductors did do better than the S&P last week, so that's a bit of encouragement. But as I indicated last week, we really need to get back above this level on the ratio to before we can start sort of celebrating that we're back into a positive mode. And for newer viewers of this video, semiconductors are very important to bullish phases of the market. You know, you're not going to get a really strong bullish phase in the market when semiconductors are underperforming. This is US large cap growth versus value on a weekly chart. Again, no change there during the week, and pretty similarly with mid caps. So you can see it's, you know, why I'm saying it's, until we see the colour of the Fed's money, it's really just a good week to sit on your hands and observe. While I'm here, let's have a quick look at the ASX 200. So the ASX 200, as you can see, relative to the moving averages, has done much better than the US. And particularly in the last week, even though our index did come off a bit, it was really very much down to materials, particularly BHP, Rio, and Fortescue, and that was with because of a more buoyant iron ore price. So, you know, I don't think these indices in Australia really tell you a great deal, but they only tell you about a couple of specific stocks. And I think if you're taking your cues on the overall market from these indices, you're probably not coming up with the right answer. There's energy in Australia. It looks very similar to the US energy situation, so it's in a bit of a corrective phase. Our finance has done better, so certainly our finance sector has outperformed the US finance sector. But it's not a great environment in the next 12 months to 2 years for the banks, I would not have thought. And finally, healthcare, which is really just down to a couple of majors. It's nowhere near as broadly based as America. And it's sort of, neutral in the middle, and again looks pretty similar to the US. So just wrapping that up, Australian dollar, I should say, 67.21. So we would, I think, pretty much the same as the prior week. 1.2 was the scoreboard for our index at the end, but really it was only materials, thanks to a stronger iron ore price, that really held our index up. If that hadn't been the case, then we would have been down similar dimension to America. Precious metals, gold was steady, 1797, and it's really stuck in a range between 1750 and 1830. In AUD, little change across the week. And look, gold analysts are very divided on 2023. There are quite a few that have turned positive and are recommending positioning into gold, and there are others that are still extremely negative. I have no opinion on gold. I don't trust the gold price, and as I've been saying all year, I prefer to go where there is value to be created because an emerging project is being de-risked. That's almost assured value creation. Whereas if you buy an existing producer where the price is tied to the gold price and you don't trust the gold price, then that's a difficult scenario. GDXJ just sort of starting to lose momentum a bit again. So on a big picture global view, I find it hard to get excited about the sector. But locally, some good results, and even some of our producers did reasonably well last week. So we'll take a quick look at that one. Sorry, just get to the right chart. There we go. So let's look at silver as well, because silver actually silver finished off very well on Friday. If you look at how silver performed on Wednesday, Thursday, Friday, so very strong move there. But if you look at gold, nowhere near as strong. So significant relative outperformance by silver. The problem in Australia, though, is getting exposure to the silver sector in a stock that is not still extremely high risk. That's the challenge in Australia. And if we look at it on a weekly basis, you can see we're still sort of stuck in this range at the moment. So that is the gold sector. Turning now to other commodities, copper was up to 382. Nickel had another good week, so a couple of very good back-to-back weeks. And BHP have said that nickel supply needs to rise by around 400%, so fourfold over the next 30 years to meet energy transition targets. And you might recall a few months ago, I also quoted BHP on copper. And, I think that from memory, they were talking that copper supply needed to increase 2 or 3 times to meet these targets. So certainly there is massive long-term value in many areas of the mining sector. Crude oil sharply lower, down to 71.6. There's a lot of geopolitical forces at the moment, which is, I think, a corrective phase was due. Oil had got a bit overheated, and I think those geopolitical forces, with the cap on the Russian oil, all those sort of things, has just hastened along this corrective phase. The long-term outlook, though, is still very robust because the requirement for fossil fuels and oil is going to remain for quite a long period of time, and there's just not going to be any investment in there. And existing fields are always in decline. So we're going to see, I think we're going to see production decline at a faster rate than demand. And that means that the price is going to remain pretty buoyant and margins will remain very good. There's opportunities building, as I indicated, in the energy sector. I find the Australian energy sector difficult, other than the obvious couple of majors. So I'm seeing some good opportunities in the US energy sector. There's the copper chart. It's been a nice rise over the last few weeks, and we're back now to the sort of levels we were trading at in the middle of the year on the way down, but we're now back on the way back up again. And there's the nickel chart doing something similar. So bringing it all together, I just think it's a good week to do nothing until we hear what the Fed has to say, because potentially the market could move significantly in either direction, and I have no idea which direction that is. I think it's an absolute toss of a coin whether the Fed is going to continue with their softer rhetoric, or whether the inflation data kicks up to a degree that they've just got to stay with the previous tone that they had. And the fact that the markets over the last 3 or 4 weeks have just really gone up and down and sideways underscores that. So that's really, until we hear from the Fed, that's what we've got in front of us. Portfolio analyst, or taking stock last week as it specifically was, it's a specific skills building session that I do once a month. We looked at a process for entry into lithium stocks. And I think, whether it's lithium stocks or it's healthcare or whatever you're investing in, you need a process that's a repeatable, solid process that you can follow. If you're just buying and selling based on your emotions, you're going to struggle. You're going to struggle in any market. And this market's as challenging as I've seen in a long, long time. So you need a process, and we looked at that. And also there was a question about one of the major trading areas that I've made in my career, and I was able to distill it down to 4 or 5 really important and big picture things. And I think if you take those things on board from my 35 years of experience, I think you might find some real value there. So for anyone that hasn't tried Portfolio Analyst, $1 for 2-week trial, I think you might find some real value there. All right, that's it for this week. There's my email address and website for more information. And I'll be back with you next Sunday, which will probably be the last video of the year. Cheers.